Jim Leitner. That was his name. That was the money manager. Jim Leitner, hedge fund manager of Falcon Management. I think he just manages his own money now. He's probably worth a cool billion plus. He's done very well for himself. But yeah, he's out of New Jersey. I've chatted with him a little bit. We're kind of best friends on LinkedIn. Anyways, no, he's a really nice guy, super smart guy. One of my favorite hedge fund managers. But Jim Leitner, yeah, he's got a chapter in Stephen Drobny's books, which are excellent reads, and I suggest you go and check them out. But anyways, okay, so this is section 3. So I just taught you what liquidity is, and you're like, okay, cool, this sounds neat, this sounds interesting, but how do I apply it? Well, that's a really good question. So I'm going to show you. I'm going to show you some of the things. This is like the meat, just the basics of what we do. All right, so gauging liquidity, temporal measurements. Temporal is a fancy $5 word for time. I'm just trying to sound smart here, guys. So when assessing liquidity, we want to look at 2 different time frames. I want to look at the big picture. This is liquidity on the cyclic scale. This is the debt cycle. I want to look at the debt cycle, right? Long-term trading and investing is about not losing money. Warren Buffett's got, one of his famous quotes is, there's 2 rules to investing. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. I'm not even a huge Buffett fan, but it's spot on. I mean, that's the game, guys. If you guys understand compounding, which you need to, you got to understand the power of compounding. It's because it works. It's an amazing thing that works for you if you're making money, but it will also kneecap the shit out of you if you start losing it and you got negative compounding working against you. It's really tough to come back. So you got to understand the mathematics behind that and how that works over the long haul. Because if you're playing this game, then I hope you've got a 5 to 10 year, 15, 20 year, trying to put together a long-term track record. Because if you're trying to just do the whole get rich quick thing, and just like, I'm going to learn this game over 6 months and then I'm going to buy myself a Ferrari and be an Instagram star, well, then you're an idiot. You're not going to do it. You're just going to give your money to people like me. So, but I don't think any of you are like that, because if you guys are here, if you're following the macro op stuff, we're definitely not the typical standard mainstream trading stuff that gets pitched, all that nonsense. So anyways, yeah, you got to understand the credit cycle, which I just told you guys about how the debt cycles work, right? And so keeping an eye on the cycle level liquidity, this is the big picture liquidity. This is going to ensure that you sidestep the bear markets, the crashes, the 2008s, the 2000s, 2001s. These are the instances where everything shits the bed. The market comes down 20+%, 30%, 40%, 50%. And then you have individual stocks, that lose, that plus some 70%, 90%, some go bust. So if you could just understand big picture liquidity and just that, if this is all you come away with from this thing, well, then you've earned an infinite return on whatever you paid for this thing, $5, $7, $10 or something. So I'm going to show you how to gauge the big picture liquidity. And then I'm also going to show you how to look at the small picture liquidity. So this is liquidity on the short to intermediate scale. Now, when the lower in time frame that you go, the higher your noise to signal ratio. Now, noise to signal, that just means like signal is just like when you're combing through a bunch of data. Well, how much of that data is just random noise and how much of it is actionable intelligence? So the further you pull out and the bigger your picture, the larger your lens, the higher the signal to noise ratio. That means the more useful the information is. The lower in time frame you get, the higher the noise comes to your signals. So it just becomes a lot of noise. I'm not saying it's not useful, because it is, which is why I'm teaching you it. But I just want to let you know that. So the noise signal ratio in the shorter time frame liquidity gauge is much higher, but tracking it is still extremely valuable. And this is going to help alert you to potential large market retraces, like a 5 to 5 to 10% market pullback. It's also good after a pullback, it's going to let you see strength before it's reflected in the market itself. So you're going to know when to buy on these pullbacks. All right, big picture liquidity gauges. So I look guys, I look at a ton of various charts. You know, we have a Reuters icon terminal that we pay buku money for, and I'm a data geek, so I love looking at tons of stuff. I mean, that's my porn. You know, not to make this weird, but I mean, like, I live in a cabin, so that's the stuff that I look at, that I get off on. I love looking at charts and just looking at esoteric data points that, like, you know, what are the Congolese kidnapping figures for this month? You know, is there any correlation to oil production? Whatever. I don't actually look at that. That's ridiculous. There would be no correlation between those two. But anyways, I look at a lot of liquidity indicators. But when it comes down to it, like, as far as like actionable, useful stuff, there's maybe only a handful. I'm going to show you guys the handful of the most basic but key indicators that I track, and they're ones specifically that you guys can track without having to pay up thousands of dollars a month for a expensive data feed, right? Because I want this to be helpful to you guys. So this is something stuff that I use. I've been using for years, and I still look at every single day. So for these big picture liquidity indicators, I'm going to show you 3 charts, and these 3 charts look at 3 various drivers or things that impact liquidity, or things that will impact liquidity, right? So anything that affects liquidity. And so out of these 3, we're going to look at inflationary pressures, financial stress, and then a composite index of growth, credit, employment, and inflation ratings. Okay. So numero uno. This is big picture liquidity indicator number 1. I've already told you that the Fed pulls the biggest lever on liquidity, and the Fed responds to inflation. It's one of their 2 primary mandates. The Michael Jordan of trading, Mr. Paul Tudor Jones, I'm sure you've heard of him. He has once said, if you look at every bear market, they've always basically occurred because of an uptick in inflation and an uptick in interest rates, right? That makes sense. Inflation rises, the Fed raises interest rates, raises the cost of money. I've already told you about all this. Even Paul Tudor Jones, he instinctually got it, but he didn't understand the full process. Well, now you do. So the first indicator for looking at this is one of my favorites. It's the unemployment indicator crossover of the 12 and 36-month moving average. It's one of my favorite cyclic measures of liquidity. This is because labor is the largest input cost in production and business. So the labor market tightens, unemployment falls, wages rise as employers compete for scarcer labor. This leads to rising wages. This cost is eventually passed to the consumer in the form of higher prices. Higher prices equal higher inflation, and that equals a Fed more prone to tighten and pull liquidity from the system. So you get that logic chain, right? The employment market tightens, that means less people that are unemployed, means the more scarce that employees become. That means there's little slack in the labor market, so employers have to pay more, so wages increase. Wages increase, that means the employers have to pass those costs borne by them onto the consumer in the form of higher prices. Higher prices equal higher inflation. Higher inflation equals meeting one of the Fed's 2 mandates of inflation. So that means a Fed more prone to tighten and pull liquidity from the system. And so that's why the unemployment moving average crossover is a great cycle level indicator, because it reflects how far the Fed is from attaining its 2 primary mandates, full employment, 2% inflation. Now, when the Fed tightens a certain amount, usually 3.25%, and the Fed funds rate, that's typically, if you look at it historically over the last 100 years, it seems to be the level where shit goes awry. In response to its mandates being met, unemployment begins to go back up. That's because the companies start to see their profit margins contract a lot, And to, in response to those contracting profit margins, well, what do they got to do? They got to cut costs. Labor is one of their biggest costs, so they got to start letting people go. So unemployment starts going back up. And when it goes back up, it crosses over the 12 and 36 moving average. Now, this indicator has triggered before every single recession over the last 75 years for which there's data. So it's got a high confidence rate. It's a very, very useful indicator. Here it is. All right, can you guys see that? So the black line is unemployment. That's my mouse. The orange line is the 12-month moving average, and the green line is the 36-month moving average. And then these gray bars here mark every recession going back over the last 75 years. So let's just take the great financial crisis, for example. So here we are, unemployment's coming down. Right around here, the Fed starts raising interest rates because the labor market is tight, inflationary pressures start turning up. What do we see? We're entering about, what is this, about 2007 right here. The market is still going up, everything's still good, but boom, you see unemployment cross the 12-month moving average. We still haven't hit a recession. We're still in a bull market nearing the top, but unemployment's going up now. And what does that mean? Well, this is the direct response to liquidity being pulled from the system. The Fed raised rates. Employers had to cut costs. They let people go. Unemployment starts rising. Rising demand means decreasing sentiment. Decreasing sentiment means less loans being made, which means falling demand. And we get that negative spiral that I told you guys about in section 2. And then boom, it crosses the 36-month moving average. And then we get a recession and a bear market, right? Same thing. Everything's hunky-dory. We're going in at, we hit 2000. And then boom, it spikes up. The market turns over in 2001. And we get a horrible bone-crushing bear market and then a recession. But this indicator signaled well before, same with the 91 recession, and on and on and on, right? That is why this is such a good high-level liquidity indicator. The unemployment rate, 12 and 36 moving average. You guys can create all of these in the Fred database, and I think we should be including a link to all that stuff in the goods that we're giving you guys. If not, just email me. But Fred is run by the St. Louis Federal Reserve Central Bank, and they have a public database where you can chart the unemployment rate. You could throw on the 12 and 36 moving average. This is something that's used by guys like Jeffrey Dunlock. It's Gunlock, the bond king. It's his favorite cyclic his favorite cyclic indicator. So very important. If you guys just use that alone, you're going to be able to sidestep every single bear market and recession. And then you're already ahead of the game. Okay, so here's the second one. This one I love too. This takes a little more granular look at liquidity at financial conditions. So what this is the Chicago Fed Adjusted National Financial Conditions Index. Right, so this is, you could chart this in Fred too. Like I said, I'm using only publicly available data so that you guys can actually, my mouse sucks. So that you guys can actually chart all this stuff. But what this is just a composite index of different financial conditions. So it measures liquidity. Are lending standards loose? Are the interest rates on junk bonds going up? So is liquidity tightening? When liquidity is above this zero line right here, that means liquidity is tightening. That means banks are lending less. That means more people are defaulting on their loans. So sentiment's about to turn negative and things are tightening. So that means demand is being destroyed. It's evaporating. That's bad, right? When things are down below, that means things are really good. Look at the meat of the 90s. Things were beautiful. When it's below zero, that means demand is credit is loose, demand is flush, liquidity is flush. But then boom, we spike up here in 98. what happened around then? The Asian financial crisis. You saw the long-term capital management blow up. So liquidity conditions started rising into 2000. And, the market kept on going up. It was carried by crazy sentiment. But you would have known, that was like a once-in-a-lifetime bull market, that you should have been paring back risk going into this because liquidity was tight. Things were unstable. And then, it came back down, but boom, you're back in 2002. Everybody was super bearish. If you guys were, I don't know if you guys were trading or watching the markets back then, but 2002, 2003, people were so bearish. But look how loose financial conditions were. You should have been buying up, things like beating down commodities, emerging markets. You would have killed it. Or even U.S. stocks, whatever. If you were just bought and then, held until liquidity conditions started tightening again, boom, here in 2007, right before the bear market started and the housing crash, the great financial crisis, you would have done very well. Oops, I'm getting ahead. And then same thing, came down, it spiked up. You would have known to be out of the market. 2010, it came down, or you could have been like, hey, I'm going to start looking for shorts here. I'm going to, buy some puts on the SPX. And then same thing, following 2010, liquidity conditions loosened significantly, get long. Sentiment was very negative, which is always good. We want to be contrarian. Buy. Sentiment or liquidity is loose. Sentiment is negative. Buy. It spiked up here recently. That's when we saw the commodity market bust, emerging market bust. That was good. It signaled beforehand, before it happened, what was going on. It gave you forewarning. And then in late 2016, early 2017, it crossed back below. That means liquidity conditions are loosening. As far as early 2017, and now I'm filming this, it's September 2017, and that's been the right call, right? Liquidity conditions have loosened a lot. People are being like, oh, the market's overvalued. We've got to see a correction when liquidity conditions are coming down. That means it's loose. That means demand strong. That means there's a bid for the market. All right, Conference Board Leading Economic Index, the LEI. I love this one. You can find this one also publicly available. So the LEI is a composite index that is a fantastic leading indicator of the business cycle and also stock market at the cyclic big picture level. The LEI has 10 components which measure everything from weekly hours worked to inflation-adjusted M2 money supply, consumer sentiment, and interest rate spreads. So all the things we look at that affect liquidity. Since these components are all leading, coincident, or lagging reflections of large-scale liquidity, the index acts as a great gauge of liquidity and where it's going. The LEI has turned over before every recession and works as a good coincident to leading indicator of the broader market. It typically leads 18 to 24 months. So if you see the LEI turnover, that means a recession is typically coming in 18 to 24 months, and a bear market in 6 to 12 months. A very valuable index to track. So here we go. I didn't put recession bands on here, but nonetheless, you could see this. Look, it peaked 2006, came down, market topped in 2007. I think it was October 17th or 27th, 2007. But you already saw it come down. You're like, oh shit, I need to pare back my lungs. I need to start hedging my book or start getting short. So well beforehand to get short. Liquidity is being sucked from the system. Right? And you see this thing trending down, get the hell out. And it gave you tons of forewarning before 2008 hit and we got a massive bear market. You could have made a killing if you were following this indicator. Same thing in 2000, right? It was going up, things were good. Bull market peaked around here in 2001, but the LEI had already turned over. It had already been trending down. You were already forewarned. We got the recession right around here. So like I said, 18 to 24 months beforehand, the LEI turned over. Here, oops. Like I said, we're in September of 2007. Where was the LEI doing? Boom, it's going straight up. It's going straight up. So again, all the bears, they just paid attention to a handful of these very basic, simple liquidity indicators. I know they don't know what liquidity is, God help them. But if they learned, they wouldn't be these ignorant bears. And they'd actually be making money in the markets, but they're not, and you will be because you're following this stuff because you're smarter. Okay, so I just showed you the big picture cyclic indicators. Now I'm going to show you the shorter term primary near to intermediate liquidity indicators. Okay, let me take a sip of my whiskey. That's good. Okay, so here's Stanley Druckenmiller one more time. I never use valuation to time the market. I use liquidity considerations and technical analysis for timing. Valuation only tells me how far the market can go once a catalyst enters the picture to change the market direction. And like I said, the lower you drop in time frame, the higher your noise to signal ratio becomes when looking at liquidity. With that said, keeping a close eye on the short-term liquidity is an invaluable tool for assessing sentiment and capital flow strength and weakness. So for this, we look at two primary indicators: the short-term trend in high-yield debt and the intermediate trend in bonds. And again, these are publicly available tools that you can use that I hope you do. So the first one is high yield or junk debt. These are low rated risky bonds. Because these are high risk and often illiquid assets, they're mostly held by more sophisticated investors, professionals, right? The guys who make their living just dealing in the junk bond market. And because of this, they tend to be very responsive to risk, real or perceived. So this is why a move in junk bonds nearly always precedes a major move in equity markets, both up and down. There's a saying that credit leads equities. That's been a saying for a long time, and it's a saying because it's true, right? So, excuse me, I got allergies. The credit leads equities, so you follow where the credit market is going, and if you see the junk bond market start selling off, well, you should probably be on the lookout for weakness in the broader equity market. So here's a little chart that I'll show you. Now this is a little bit fancy, but this is just something I built up in our Reuters icon. It's one of our indicators that we track that people in our collective have access to. But this is a, excuse me. All this is this red is the monthly moving average of the negative weekly percentage changes in the junk bond market. Right, so when it drops a lot, that means the junk bond market is having sharp moves over a short period of time lower. So here we go back in 2015. This was the market had been going up for a couple of years. Everything was good. But it started to stall out a little bit. But there was, everything seemed fine on the surface. But if you looked at the junk bond market, you started to see the sell-off a lot, right? And so, like around here, when you start to see a sell-off across the 0.5, I start paying close attention. When it crosses the 0.1, we get a risk-off signal. That means shit is about to hit the fan. There's no turning back. The market is going to sell off. Now, a lot of people are saying, this is a good buying opportunity, because the market hadn't had a big sell-off in a long time. And then what happens? Boom. It shits the bed, right? It had like a 10% sell-off. It bounced around. But what do we see here? So like right here, things, people are like freaking out and it's going to sell lower. But if we look at the junk bond market, it's already reversed and it's going back. So we see that it already collapses up to like 0.25 while it's down here. Oh, well, there's a good buying opportunity right there. So you could have bought, boom, you're back up here. Things are good. You just made a lot of money. But while it's chopping around, what do you see? You go straight down. We got another risk-off signal right here, right? And so, here's the lines. They line up. So you got, that's when the market started selling off, but you got it right here. So to close out your longs, right? You close them out. Maybe you go short. I actually was buying puts. I bought some short-term puts, and then I 5x'd my risk multiple times on these back in 2015. It's a really easy trade. And so you see the market sell off, right? And then same thing here. Things are really bad. People thought that this was the beginning of a bear market. But if you just looked at credit again, price action is down here. It looks like everything's going to hell. But credit starts rebounding. And so you could have just bought, and this would have been a great buying opportunity. And then you just go up and you see, okay, well, credit's fine. Sometimes, like I said, the noise to signal ratio is a little bit higher. So you get, maybe you would have closed out your longs right here, but you would have been right back in the market right here. But you would have just known to stay long until it crosses a risk off signal. Very easy. And so just another way of looking at this is just one way of looking at it, but you could just type in, look at the junk bond ETF, like JNK or HYG. You could type that into stock charts or trading view, whatever charting platform that you look at. And then just look at the trend direction of where they're going, over a month period. Is it going up with the market? Is it going down while the market's going up, or is it going sideways? You want to see the action in junk bonds confirming the action in equities. Okay, so bonds and equities, this is important. So bonds and equities compete for capital flows, right? Like there's a limited amount of money in the system that seeks returns on assets. Capital flows to where it's treated best, where it can get the best perceived risk-adjusted return. So this means that bonds of all credit qualities, from risk-free sovereign bonds like U.S. Treasuries to speculative high-yield debt, compete with stocks for money flows, right? So when bond yields are rising, that's actually bad for stocks, because that means if you can get a higher yield on a risk-free treasury bond, let's say like 3% on a 10-year or something like that, well, then if that's gone up, then that's gonna start competing with stocks that might be highly valued for capital flows. Because why would investors want to take risk on a risky company, a risky stock that can go to zero or something like that, when they're already highly valued, when they could get 3% or 4% or whatever in a bond that's higher up the capital structure, or a sovereign bond that's basically risk-free, right? So knowing that, this is why rising bond yields are bad for stocks, because higher yields mean stocks have a higher bar to clear, because investors should always want to put their money in bonds first if they can get a similar risk-adjusted return to stocks. So a higher bond yield means stocks become less attractive. Like I said, why hold overvalued and risky stocks when you can hold risk-free bonds at a higher rate, right? So knowing that is why it's important to track the trend and rate of change in bonds, both corporate and sovereign. One of my favorite indicators for this is the 26-week percentage change in U.S. corporate bonds, BAA. You can find this data again in Fred. So here we go. Black line, we have the stock market up here, the S&P. And then we have, this is the U.S. corporate bond Moody's seasoned BAA rating. Don't worry about the nomenclature. It's not that complicated. But this just tracks the 26-week percentage change of how things move over 26-week period, a 6-month period, right? And so when we see yields, this is something else that we use in our collective, something that we watch. But when you see yields peak up above here, that means yields are rising quickly. And that means when they cross this line, and the higher they get, especially when they get above the second red line, that means they're really competing with stocks. And that means they're going to start to pull money from stocks. And that means there's a greater chance that stocks are going to go down, because the bonds are pulling more money flows. That's why you see, like back here in 2007 when the market topped, well, you saw that bonds had gone up quickly, right? And this is all part of the Fed, again, the game masters. They raise interest rates, the rate on bonds go up. Bonds compete with money, with stocks for capital flows. And so stocks turn over. We see it again here. And this is, back in, in 2006, which this, rising bond yields preceded a large, bumpy, volatile period in the market. And you could see it, again in here, right? So this preceded the large sell-off in 2015 when bond yields spiked, boom. But then, like here, you still got some volatility, but like on the long-term chart, it's less noticeable because noise is signal, right? Right now, bond yields are falling. They're below the bottom red line. That means liquidity conditions are loose. You don't have bonds are not really competing with stocks for capital flows. So what does that mean? Be long equities. Be long equities. Up there, typically when it gets up here, you want to switch and be long bonds. So That is section 3, the conclusion. I just showed you my liquidity gauges. Yeah. I hopefully you guys got some from that. Those are actually really cool stuff. And so, like I said, if you want the links to that, just hit me up. Or I think we're giving them to you in a worksheet. But you could punch that stuff all up in Fred and track it. And I really suggest you do, because that's gonna help your trading big time. So that concludes our liquidity indicator piece. Man, it's good stuff. Hopefully you guys liked it. I hope I'm impressing upon you how important this stuff is, and I hope you enjoy it as much as I do. Because if you get this and you really understand the power of compounding, well, you're going to understand like, oh, well, man, if I just pay attention to these, even if you're just a value, dyed-in-the-wool value investor, well, you know what? I'm going to pay attention to these big cycle liquidity indicators that Alex just showed me, because, that's going to help me fight my negative compounding that hits me when the cycle turns and I get a bear market. I'm just going to sidestep those. Boom. You'll make an exponential amount of more money over the long haul if you follow that. So yeah, hopefully you got something out of it. That was our second to last section. So our next section, I'm going to be covering China, and we'll be walking through this as an example. All right, I'll see you guys in a bit.